All right, CJ, October 27th. Here's another month. We can just, put it in the can.
That's
Not
right.
exactly the month I was looking for, though. I don't know about you.
No, no. I mean, I can remember just 3 or 4 weeks ago talking about everything looking like the market should give us a really nice tailwind. I call
Yeah.
them trade winds because obviously the trade winds from back in the day when we had boats sailing out there. But yeah, some really strong trade winds just didn't come through. Not yet, at
No,
least.
no, not, yeah. I mean, just wow. I mean, we look back. I'm just looking at the end of, I mean, you look at the S&P, it's not down. I mean, it's not down like crash down, but we did make new lows. We did make new lows this week that took out those lows of September. I mean, September we were sitting around 425 on the S&P. We're kicking down to around 415 right now. So I mean, it's not like it's double digit lows. It's a couple of percentage points lower, but it is kind of aggravating that you see things that happen time and time and time again, and everything was setting up really nice for what we thought was a big run up, and it didn't happen. So in
Right.
today's podcast, folks, we're going to talk about aggravation. We're going to talk about correlation. We're going to talk about prediction, right? Which came off an earlier video I did. But man, I tell you what, I need I need to turn the brain receptors off. They're telling me go back to sleep. Because that's really what coffee does, isn't it? I mean,
Uh,
coffee's advertises this thing that's just supposed to wake you up. It doesn't wake you up. It just turns off the part of the brain that says go back to sleep.
Sounds it out. Right.
That's what
Get
it
it out
does.
of there. Put some blinders on. Get your day going. Let's
Yeah.
go. Yep.
All right. Let me first show everybody what I'm looking at here. So here's the S&P 500. This is going back into Memorial Day when we were down here before. Check this out, CJ. We're back down to the lows that happened around Memorial Day, just after Memorial Day weekend. And
Yep.
so, if you can recall back then, we were at 415. All right, we started the journey up to the highest for the year, which were at 460. And ever since then, I mean, ever since the end of July, we saw that drop down into the end of August. A little bit of a pop up, didn't last long. Here's end of August. Here's middle of August. Boom, back up. Had a little dipsy do here that took us into the end of September. And this is the end of September right in here, all right, 425. And
Mhm.
when CJ and I are looking at this and we're starting to climb back out, back at just a couple weeks ago, we thought, here it goes. And there it went as we tripped back down to new lows heading into the end of October. All right. So we'll talk about where we see November taking us here before we're done with the podcast. But that's the first thing I see is that we've dropped back to some significant support level that started all the way back at the end of summer. Let's tie all this together, and then I'm going to give you the mic, CJ. I mean, bond market, boom. I mean, just every channel, long, short, intermediate, are all pointing in the same direction. Now, at this point, this thing's starting to look like it's. I mean, it's overcooked, but we really won't know. I think what we've got to do is we've got to go through now. Got to have in November, the first Friday in November. Take a look at those numbers. Fed's going to meet again. They're going to make some decisions. I really think this is all going to tie down to the holiday season. I don't know about you, but that holiday season is really going to look interesting this year.
Yeah. Tom, I've got an old rule, and we love rules in investing, right? I call it my annual bonus trade. And this is back from when I managed money. So this is back when we had, hundreds of millions that were piled up in funds and ETFs that we were managing. And one of the things that we did was we bought the retail sector the day after Labor Day. Day
Okay.
after Labor Day. I mean, we blind bought it. We'd done all kinds of research and looked at the trends. And if you bought the XRT, or back then we used Fidelity, Ridex funds had a retail fund, and Fidelity had a retail fund that we used as well. And we just buy it and hold it, and you sold it on Black Friday. You sold it the day after Thanksgiving. Bit of a sentiment trade, and selling it the day after Thanksgiving, kind of a
Yeah.
get out before everybody sells the news. That trade hit almost every year for us, and it would hit big. You always saw it outperform the S&P 500. You saw it outperform pretty much everything out there. This year, when I look at that, it's not, and I'm going to do another video to get in depth on this. It is what I call a bifurcated sector now. And it's so simple, but it just hit me the other day. Why? If you look in it, Whirlpool is a consumer discretionary. It's considered a retail stock, right? Because they sell products.
Yeah.
They just dropped a rock in terms of earnings, and the stock is trading down 12% today. Or yesterday, it's down huge. Another one from this week, Align Technologies, is a consumer discretionary stock, not a retailer where you can go in and buy stuff in the store, but it's a consumer discretionary and fits in that same category. They're down 22%, 25% this week because what? People aren't buying them, right? The
Yeah.
one thing that has to do, or the common denominator in this bifurcation of the sectors, is whether or not, you pull out a piece of paper
All
that
right.
maybe
Speaking
looks
of the
like
mic there.
this, that has all kinds of writing on it and all kinds of legalese and all of that, and interest rates at the end of it on what you're paying. If you have to sign to buy what you're buying at the moment in the store, at the dealership, at whatever, and it's got an interest rate popped on it, chances are that stock is part of this retail sector that is going down, and
Yeah.
everybody else is starting to go up. So I think that talks about the absolute confusion in this market and how people aren't able to go out there and that's why the S&P 500 isn't ripping through its seasonal strength right now. That's
Yeah.
why.
You know what? I mean, don't you also have to agree that, part of this is interest rate environment. Part of this
Mhm.
is, is the amount of legal paperwork you gotta do just to pick something up that costs more than $20. But
Yeah.
part of it's also, look at Whirlpool. What regular people are doing right now, CJ? They're not buying new appliances. They're going on eBay. They're looking for the used stuff that
Mhm.
actually holds up over time.
Right.
It's amazing. My wife and I have a condo. We have a little getaway condo. It has
Mhm.
an old dishwasher in it, an old one, a white one, not stainless steel, not the
Right.
same color as the cabinets. This thing is old and white. I wanted to pull it out because it's an eyesore. My wife said, this thing actually washes dishes in less than an hour. And if the dishwasher I have at our house, I run that thing. It says 240 minutes on it
Yeah.
to get started. And we're talking about the one at my condo will wash dishes, I think, in like 40, 45 minutes. There's a big difference between the two. And you start to think, he's like, oh, it's because of the energy saving features of the old
Mhm.
one. Well, what good are the energy saving features if it takes 3 or 4 times as long to wash the dishes? Is it saving any water at all? Is it saving any electricity? I don't think so.
Right.
And so when I talk to my brother-in-law, he's big on durable goods. He's
Mhm.
always looking for the old stuff, the speed queens. That
Oh,
he tells me, hey, this is where you got to go. You got to go get one of these. Forget those front loading things. He goes, those are junk. You got to get the top load. You got to get the top load that's prior to X number of year. That's direct drive. It does this. It does that. He goes, but they hold up over time. And
yeah.
he goes, they make a big stink about the fact that they're not energy savers. They are, because they do the job in a
Quickly.
quarter of the time.
Right.
And so I think that undertone is coming back on some of the quote unquote durable goods that are not so durable anymore. And I think that's causing a problem with companies like Whirlpool.
Yeah, you're absolutely right. There's also, the expectations of the retailer right now. When you go and buy, I can remember when we bought, dishwashers and clothing washers and all this stuff. Man, my parents, you went out, you spent the extra money, and you had something that sat there for 20 years. Now you go out and you spend the extra money, you got something that lasts 5 years.
Yeah.
And
I'm
it,
telling you, when we moved in this house,
Mhm.
my wife said, get rid of the front loads and let's pull the old ones from the other house.
Yep.
That's what we did. She
Yeah.
says, pull the other ones from the old house. We'll swap them. The new ones look great, but I mean,
Yeah.
when you start using them, it just
Right.
doesn't do the job. Something else I want to look at too, which is causing whirlpool and a lot of other stocks to take a sidelines. You said it. It's the U.S. dollar. Take a look at this chart of UUP.
Yep.
UUP, the double dollar index, trading at 27.5 just a couple months ago. It's now hitting fresh highs as we speak, above 30. This is a big deal. And when I look at things like, so I'm kind of anxious every once in a while what the New Zealand dollar's doing, because I got a place over there, and we get stuff done to it all the time. Maintenance has to happen.
Mhm.
I'm not there to cut the grass. I'm not there to pull the weeds. I'm not there to restain the deck. I got to get companies to do this. I got to get people to do this. And so I need to pay them in New Zealand dollars.
Mm.
I'm telling you, man, the New
Yeah.
Zealand dollar, just a couple months ago, we were in the 60s. We were in the low to mid 60s, like 62, 64,
Oh,
which means basically it was 64 cents US to buy one New Zealand dollar.
right.
Today, it's in the 50s. It's like in around 57 cents. So you might say, well, 64 and 57 cents is not that big of a deal. Folks, that's 10 to 15% off right now. I mean, if
Yep.
there's ever a time, and let me put it back to those of you that are watching this podcast, or those of you listening to the podcast, because you're trying to find a cure for insomnia. So you listen to me and CJ and I. There's not been a better time right now to go travel abroad and trade in some US dollars for some foreign
Yeah.
currency. I mean, you're going to see a couple things are going to happen here, folks. You already got better purchasing power with the US dollar, number one. You know what else you have? Airlines are now starting to see a few empty seats on the long haul flights. And the reason I know this is because they're going on sale. They typically only go on sale the day after Thanksgiving. And here we are, end of October, and they're already starting to get flights to the Pacific, to Pacific Islands, to Asia, to Europe. And they're starting to crank them down a little bit. I'm seeing it. I'm seeing it happening. And not just in coach, seeing it in premium economy, seeing it in business class. That's it. A lot of this is tied to the chart you see on the screen right now. Let's throw two more up there. Crude oil. Well, crude oil is going up. Wait a minute. If the U.S. dollar is going up, CJ, doesn't that typically make commodities like crude oil go down? And if so, why is crude oil catching bids last month at 70 for USO, catching bids just even this week at the mid 70s, looking like it wants to move higher? What's going on, CJ?
Well, you've got a couple things. The obvious answer here is risk premium that's going on with the Middle East. That's not going to go. And we've seen USO pull back for the last couple of days here. And there's been a delay in Israel and their next operation with Gaza, let's say, going into Gaza. So I think the oil markets have have relaxed a little bit in terms of that fear. But I think you and I both know, as soon as we hear or read those headlines about Israel going into that next phase, there is going to be, a risk premium added, because look around, look at what's happened there, Tom. And it's kind of blowing my mind. You've got China that has now sent warships to the area. You've got Iran that is coming up and saying, we're not going to, this is going to push, things to the brink. Russia's kind of a little quiet, but that's because they've got Ukraine to worry about right now. But the idea that this could turn into a larger theater in the Middle East is now, very much growing as something that could happen. And man, that is going to fuel oil for sure. This little pullback that we're seeing, I think, has to do with just the waiting game right now. We'll see things shoot right back up again and take us probably to the top of your channel there that you've got drawn.
Yeah. Hey, the other thing I want to mention too is, let's take a look at the surprise factors, which shouldn't be a surprise, but GLD. I mean, look what it's done for the month of October. Talk about something that's going opposite of the market right now. Yep. GLD has definitely done that, gone up pretty much for the entire month of October. And you know what else popped up since last week too? Bitcoin. You and I talking 7 days ago,
Yeah.
Bitcoin was in the high 20s. We hit 35,000.
Yeah.
The last couple days in a row, we're bouncing and knocking around 35,000. Now, part of that is because of, looking at an alternative to fiat currencies. And part of that's because a lot of people are thinking that this Bitcoin ETF, this physical ETF that Larry Fink and the BlackRock boys are possibly going to get an approval for the very first ever Bitcoin ETF. And I'm not talking about, Bido, somebody out there, but Bido's the first ETF.
Mm-hmm.
No, it's not. It's based on the futures market. It's not based on the physical asset. And
Exactly.
the futures market, in my mind, has actually hurt Bitcoin because there are short sellers out there that are pushing Bitcoin down by selling futures contracts. This
Right.
Bitcoin ETF will be based off the physical asset. You know what's going to happen if this gets approved? You're going to see Bitcoin go crazy because now it's going to get tilted to the buy side. B, institutions are going to come running in. And C, all those short sellers on the future side are going to have to run for cover. And so you're going to see, you could see a double. You could see us sitting at all-time highs very shortly after that Bitcoin futures ETF gets approved. And if BlackRock gets approved, everybody else is going to jump in with their own Bitcoin ETF, physical asset, which will even cause more of a scarcity in that token.
Yeah. And you know what? Just today, Tom, or yesterday, actually, you had JP Morgan come in saying that if the SEC doesn't approve this, there are going to be multiple lawsuits against the SEC.
Yeah.
So this is not only, obviously you and I talked last week about Larry Fink, and when he says something, usually it happens, usually they get that done. He's the big dog out there, even though we tend to listen to Jamie Dimon and a few other, but you've got JP Morgan now coming in saying, hey, we're going to be pushing this thing too. This is, I heard somebody dare say guaranteed to happen by December. I don't know that you see in December, but 2025, I think we have a Bitcoin ETF that's trading on spot.
Yep.
Yeah.
I think so too. So let's just end this little section right here. Let's talk about the auto industry.
Ooh.
I didn't prep you for this one.
Yeah.
All right.
Yeah.
Let's talk about the auto industry. I heard just recently news that Ford is looking like they want to strike a deal with the UAW.
Yes.
Have you heard this?
Yes. Saw it last night. I couldn't fall asleep, Tom. And so I'll don't tell anybody, but every once in a while when I can't fall asleep, I'll hit like an Instagram or something like that. And it was maybe 2:30 in the morning. I saw them announcing that they had a preliminary deal with Ford.
Mm-hmm.
If you look how the stock traded afterwards, it looks like preliminary deal maybe is not such a great deal. They've got to take it to the rank and file, obviously, but
there it is. There's the pop. The open after that announcement, and then it dropped afterwards. So it's dropping right back in to really that average of where it's been in the last 5 days.
Right.
So, what is that? Now, did Ford get the deal and GM didn't yet?
Yes.
So
right now it's one of
GM.
three. One of three.
GM also got a little bit of a pop and drop as well, and it's back down to its 5-day average because I think with the UAW, what's good for Ford means that GM would likely to follow. I mean, these guys are going to when one of them caves or makes a deal, the other's got to make a deal quick because all of a sudden it's not us versus them. It's now me versus you in the auto industry, not us in the auto industry versus the United Autos Working Union. If one cuts a deal, then all of a sudden they're back to work and the others are sitting here waiting. And one company's manufacturing autos and the other's still sitting on the sidelines.
Yeah. And it's interesting you put it that way because we have heard the CEOs of the automobile companies come out and give that message strongly and saying that it shouldn't be us against the union. It should be us against Tesla. It should be us against Honda and Toyota, and them saying Honda and Toyota and Tesla and all these other companies love the fact that we're locked up with the unions right now. So they've been trying to deliver that message that they needed to be a united front, because it's not just them against labor, it's them against the world right now,
Yeah.
in terms of EV especially. But
Yeah.
I found it interesting. You know, they closed down the GM plant in Arlington, Texas earlier this week.
Yeah.
Right
Yeah. The
after,
SUV plant.
right. And it was right after GM's earnings hit the tape. Mary Barra's out there talking about record earnings, et cetera, et cetera. And within 10 minutes, they had the social media apps buzzing
Yeah.
with social, or I'm sorry, it was record revenue should equal record contracts. And it,
Oh, I mean, if you're Mary Barra, you're really caught between a rock and a hard place, because
right,
you at the end of the day, you gotta, people are always like, oh, all these companies are worried about is their investors. They have to be. These are the people they're responsible
right.
for your employment as
That's right.
an employee. I mean, as much as you might want to hate them, unfortunately, it's a necessary evil. It's kind
That's
of
right.
like I was talking to uh, nieces and nephews the other day. And they're like, oh, I work retail, because that's the first job you do when you're coming out of high
Sure.
school, you come out of college, and you're entering the workforce. You work in retail, you work in some sort of a job before you get to your career. Oh, I hate these customers. All the time I'm stocking merchandise, and they come in and they screw up my shelves, and they open my boxes, and they tear into stuff, and then I got to fix it. Those damn
Oof.
customers. I hate to say it, but those damn customers are the reason you got a job.
Paying your
And
money.
so,
Yep.
I mean, look at the bigger picture, folks. And I'm not talking about the part-time help at at a supermarket. I'm talking about to the UAW. I'm talking to the folks that are there. The reason why these shareholders exist is to fund the company to give you a job. And of course, they're looking for a return on their investment.
Right.
Boom, drop the microphone.
That's it. That's it.
All right.
I
So
mean,
let's talk about investors, CJ.
yeah.
Investors have had a tough month. And so, one of the things that the questions that came up for me this month is, well, how do you diversify against risk? We sit here and go, oh yeah, you use options. You also blend a mix of fixed income with risk income. But you know what? There's one more way, and I was looking at it this week, because I've got a lot of buy and hold. I've got a lot of long positions, and actually some of them have done really well. I mean, I'm looking at the markets right now as we speak.
Mm-hmm.
And the indexes on average are or they're down more than 1%. Yet I've got a portfolio that is a mix of stocks that right now that overall portfolio is up about 0.5% today. Well, how
Mm-hmm.
can the overall markets be down 1% and me be up 1%? Well, it's because it's not just the mix of strategy I'm using, but it's the mix of stocks. It is what I call correlation. So I thought what we'd do is we'll take a quick look, and I got it up right now. I have something called Correlation Analyzer. We're going to look at the stocks of the S&P 500, and we're going to correlate them to SPY to see what stocks in the S&P 500 are not moving with the market.
Mm-hmm.
So the first thing I thought I'd do is I'll go ahead and take a look at the stocks that are in the highly correlated asset right here. Let's take a look at those. And so I ran that list, and if you come down here, you'll see there's SPY. Now, SPY is going to correlate with SPY 100%. True or false?
True.
Yeah, it's not a trick question. But take a look at this. Autodesk right now is the number one stock in the S&P that's running with the S&P over the last 20 days, over the month of October. Intuit, 96%. EQR, 96%. CPT, 96%. PSA, 95%. Garmin, etc. These are the ones that are running, that are correlating. Now, if I roll down, and I could just keep going and going of the top 50 stocks, even Marriott is correlating. But with the flip of a button here, we can look at what's inversely correlating. Let's look at those top stocks that are inversely correlating over the last 20 days, the month of October. Check this out. Netflix has been correlating against the market now some 77% of the time. It's moving opposite of the SPY. Procter & Gamble over here at number 3, 64%. McDonald's, 64%. Do you think the folks at McDonald's are going to care whether the market's dropping, whether interest rates are rising, as they're standing in line, waiting to get that Happy Meal for the kids and the Big Mac for themselves?
Nope.
No, they're not. When you go through a drive-through, CJ, and you got your little kids with you, they're screaming and yelling in the back seat because maybe a soccer game, you're going by and you see McDonald's and you think yourselves, this will shut them up. And you pull in and you get Happy Meals. Two things are going to happen. They're going to stop screaming. And after about 10 minutes after they've eaten that Happy Meal and they've played with that toy till they've broken it, they're out.
They're sleeping.
That stuff's going to hit them like poison.
Yep.
That's why McDonald's is not correlating with the S&P 100%. There you go. And finally, let's take a look at something I like to call extremely non-correlated. Now, extremely non-correlated is going to be a list of stocks that are going to go up or down unto themselves, not so much with the S&P. So when you look here, what we're looking for is something as close to zero as possible.
Right.
LMT, clock it in there at number 1.
Wow.
Look at First Solar. I mean, it's pretty close too. And then you got WTW, Merck, Baxter, Marathon Oil, Valero Oil. I see a pattern here. Drug stocks and energy stocks are not correlating. They did not correlate at all with the S&P 500 for the month. Yeah, a couple days they did go down when the SP went down. A couple days it did go up when the SP went up. But most of the time, they were kind of doing their own thing.
Yep.
And that's what we're talking about with correlation, folks. One way to diversify risk is to simply spread your risk around to different stocks. And this is one way to do it. Look at the stocks that are not moving with the S&P 500. You can actually build a list. And then you can take that list and you can run rules-based trading strategies on that list, knowing that much of the time, it's not going to be affected by what the overall market does. All right. So we talked aggravation. We talked correlation. Let's talk stock prediction. So, CJ, earlier this week, I put a video out, did a little article on how you can use options to predict where stock prices are likely going to go, all right, in terms of range coming out of earnings. Now, this works more often than not, but I want to test it against 3 stocks this week. The 3 biggest stocks that announced earnings. Amazon's still yet to announce, or we're yet to see the big movement off of Amazon's announcement from Thursday afternoon. But I want to talk about 3 stocks, and let's just see what they did. So I'm leaving the screen up. We're going to start with Microsoft. So Microsoft announced earnings on the 23rd. Here it is, right over here, ready to announce. Stock closed around 330.5. I'm going to pop over and I'm going to look at the options on Microsoft because I'm going to show you guys. And again, if you want to see the details on this, what I basically do is I run that option chain at the close of the day, and I take the options that have the least days to expiration that go through earnings. So if the earnings are announced on October 23rd, then I'm going to use the October 27th options. They're the ones that close right after. They expire after the earnings announcement. They're going to be most affected by the earnings. So I'm going to quickly update that. And I'm going to look down here, and I'm actually going to take just those close to the money options. And there they are. There's your 330 calls, basically about $8, and your 330 puts, 7.5. So we're talking about something that's about 15.5 points. Do you concur, CJ? If you take the call and the put and you add them together. In fact, if you want to take the asks, it's about 16, around 16 points.
Yep.
So what that means is that more often than not, going through earnings, Microsoft is going to hold the line 16 points above this closing number and 16 points below it. So we're really talking about 346 on the upside and about 314 on the downside. So now, if we go back to the chart, 346 to 316, let's get over there. Here's Microsoft. Let's see what happened the next day. So I plus a day. There's it jumped. So Microsoft did jump up, but it closed at $340 the day after earnings. So it did hold that. The option traders were definitely spot on when it came to Microsoft.
Look at that high.
Here's where things kind of get fuzzy.
Look at that high, though.
Yeah.
346.20.
Yeah.
I mean, that's
and you know what? It really is. You look at the open, because what happens after the open is,
right.
To me, that's anyone's game. But you can get an idea where that price is gonna land. All right, let's take a look at the next one. All right, so here's Meta. Now this is Meta before earnings. It had a big drop the day before earnings because the market was down. So Meta came in right around 300. All right, volatility's popping a little bit. Let's see what happened to the stock. So the options, let's go look at the options on Meta. And I'm looking at those October 27 options, and here they are. Basically, the 300 calls are about $14, and the 300 puts are about $14. So we're talking about $28 of range above and below. So we're talking about $28 above 300, $28 below 300. Let's go back to the chart. Let's move forward a day. Let's see if it held that range. Boom.
Ooh.
Okay, so look at the open, though. It opened at 295. It closed at 287. Still within the $28 tolerance. That's pretty good.
It is.
When you look at where Meta actually ended up going, you're like, wow, that thing dropped really hard. But the option traders expected that.
Mm-hmm.
And then, of course, look at that volatility. Boom. The volatility dropped even harder than the stock. All right, so we got two option traders in the win category. Let's look at the third one. Google. All right, so Google was coming in right before earnings and was sitting right around $138. Let's go to the options. Here's the option chain. Look for 138 to 138 calls, about 440. The 138 puts about 350. So you're really talking about $8 there, roughly $8. So 130 to the downside and about 146 to the upside is what we're looking for that range to hold. Let's go back to the chart of Google. Let's move it forward a day. And look at that. Where did it open? Did it open in that area we were looking for? 130. No, it opened below and it closed below. So even though it was saying, 130 is where we were likely to head to the downside, I mean, just the shock and awe of what happened to Google pushed it outside of where the option traders expected that stock to go. So stock prediction, really to kind of give you guys an idea, it's a tool, all right? And like any tool in the market, it's not 100% guaranteed. But more often than not, we're able to take the short-term call and the short-term put, the at-the-monies, and based on that gauge going into earnings, we're able to get a good idea of where that stock is likely to fall. And it usually sticks inside that range. And two of the three most popular stocks we were looking at this week did indeed stick the range. Google was the outlier. All right. So CJ, I'm going to give you the last word when it comes to what kind of education do you have for these folks that you want to
why don't we
share as we end?
Why don't we look at one? Well, we'll worry about Amazon next week, because obviously Amazon is the one that's left out of those companies that, the market has really been looking forward to. And Apple next week, right? Maybe
Apple reports next week.
Yeah, in hindsight.
We'll look at the two A's. We'll take a look at the two A's in FANG next week.
Yeah. How about this, Tom? Because I get this question often, I'm sure you do as well, and it kind of hits on what we were just doing there. When you're looking at, let's say, taking a position, and let's throw earnings out of the equation. Let's say that you got a stock that, whether it is seasonality, whether it is a breaking of moving average, breaking into a new trend, whatever it is, you want to take a position in it. And let's even throw away bullish or bearish. Doesn't matter which direction it's going. But how do you assign a time frame for the option that you're going to use to leverage that move? A lot of people, we've got this trading mentality out there that's running wild. And you and I have discussed this, a couple of times, how trading is different because of the pandemic, and people were trading 0-day to expiration options and options that expired in 2 days. And you and I think, are both on the same page. These are terrible products for the market. But
Yeah.
is there a steadfast rule that you, Tom Gentile, use when you want to position yourself in something that is getting ready to break out in terms of the expiration that you use? How much time do you buy?
Well, it depends on what type of analysis or what type of system strategy you're using. And so, if it's a long-term strategy, then I'm going to look at long-term options. If it's something that's inside of 30 days, I'm going to look at the 30-day strike or a 30-day expiration. Let's talk about positions like let's just talk about positions like this one for a moment. So we were talking about looking at FANG and looking at options around earnings. One of the things I'll do is I look at this red line is the most important thing to me when it comes to options. Are they cheap, as they were with Google about a month ago, or are they expensive, as they were with Google a day or two ago? And based on where that red line sits in the range of the chart, tells me whether I want to be an option buyer or I want to be an option seller, whether I want to be a buyer of premium or a seller of premium, because to me, that's where the odds actually get in your favor. You don't want to buy call or put options on. Okay, Google, you'd have made some money if you bought put options. That's for sure. But I'm telling you, Microsoft, Meta, you would not have bought. You wouldn't have made money on the calls. But you know what? You probably wouldn't have made money on the puts either, because they were too expensive before earnings. Same thing with Microsoft. You're thinking, oh wow, I would have made money on these call options. I hate to say it, but you'd have been lucky to break even on out of the money calls. And that's where a lot of the novice traders go. That's short term. Long term, I look at, a longer term chart. If I'm going out 90 days or greater, maybe I'm going to buy that 3 month, 6 month, maybe I'm going to buy that leap option. It's all about where your expectations are for the stock and whether or not that option is going to give you a realistic return for that expectation. How many times, CJ, have you and I sat back and said, oh, XYZ, we see everything on our charts and everything in the tea leaves say it's going up 10%. And you look at the option, and the option's trading for 15% of the stock price.
Yeah.
And how many, in my novice career, I wouldn't have even looked at the options. And then down the road, I went, wait a second, how come the stock went up and did exactly what I expected it to do, and I lost money? Because you didn't evaluate how much those options were going to cost you to take a position. That's, really the best thing I could do as far as giving out a little experience as an option trader. And I got to tell you, I can't stress enough that for every option that I am buying, I'm selling something somewhere else. I actually want to be theta neutral, if not theta positive, especially in a time frame like this. And I'll put this will be the last chart I showed today. It's going to be the first chart I showed. Will be the last again. SPY. See that? See what's going on right there, CJ? We've gone from down. You go back to the end of August, the beginning of September, and you'll see lows. You'll see the low. We were in the single digits. Imagine your VIX trading down in the low, in the 10 or 11 or 12 range. The S&P, the options on the S&P were trading at a 9. Today, they're double that.
Yep.
So basically what's happening is you're paying double for the same option premium now as you were just 2 months ago. All right, let's take the McDonald's theory again. They got rid of those 99-cent value meals a long time ago because they're not helping the company out. So, think about this. Let's say you pay $1.99 for a Big Mac. Next month you go to McDonald's, and all of a sudden they say, no, it's $3.99 now. Same Big Mac, same amount of pickles, lettuce, cheese on a sesame seed bun, twice the price. How you feeling now as you chew on that Big Mac? You're feeling about $2 poorer.
Yep.
Same thing with options, folks. I mean, right now you're chewing on at the money calls and at the money puts, and on average, you're paying twice as much for them now. So I would rather put a trade together that allows me to sell this extra premium. Be a seller when options implied volatility is high. Be a buyer when options implied volatility is low. That's my thought, CJ. All right, last word for you. What do you think?
Let's do market real quickly. I'm going to throw out a market seasonality. Happen or not, Tom?
I think we have to go through the first week in November. We'll be back here next week. Let's see what the numbers, the tea leaves say for average hourly earnings, unemployment. But yeah, I mean, you know what? Almost 10 out of 10 the last 10 years we've seen, actually 9 out of the last 10 years. I do remember recalling not so many years ago where the market actually went down
2019
into earnings. But 9 out of the last 10 years we've seen the markets climb during the holiday season. So the pattern is there. Is the pattern going to revert itself? We will see. I tell you what, I do see on the market a lot more. Houses here in Florida, finally starting to see a lot of new inventory coming on, a lot more new inventory coming on, and a lot of older inventory sitting longer than it has in years.
Yeah, we're still not there in Ohio. We're still, I think 5 days is what you're turning here.
Wow.
Right now. So 5 days is still, we've got a very active market. But I mean, 8% 30-year price, mortgage levels they're not going to help push things.
I mean, man, 8%, we're talking, I start thinking about that, and this is where my brain goes. The Carter administration.
It's exactly the way this is feeling right now. Fuel prices going higher.
Yeah.
Everything's going higher. And I did hear somebody talking, a mortgage banking analyst talking about how they think we're going to see 10 for prime lending, 10% on the 30-year for prime. Applications. So
that's more than 20% above where we are now. So I mean, that for those of you that are mixing your portfolio and you're taking a portion of it and putting it into fixed income, maybe SGOV as an example, you got to be feeling pretty smart right now. I mean, you may not, you may still see your account going down, your long-term account going lower. But it's not moving down at the level that the market's moving down because you have a portion of it set aside earning interest income.
That's correct.
All right, CJ, Thank you so much for your time, my friend.
Great week, Tom.
Yes, sir.
Great week.
Yeah.
Great week. Yeah.
And for those of you that are watching or listening to the podcast, I want to thank you for always hanging out here with us. We'll be back again, same time, same channel next week. We'll see you then. Bye.
Have a great week.